In this segment, we're going to go deeper into what is happening with the consumer, what is the health of the consumer, what is happening with retail sales and holiday sales so far. So one of the things that we've been talking the most about is just consumer credit. And this is just showing you another chart of consumer credit gone wild. And it's not surprising, a lot of the things that we've been highlighting in terms of cash advances, some of the credit card debt, a lot of these things are now starting to level off and go back up as people are looking to pull forward some of that spending, again, trying to get ahead of what we all know as supply chain issues and before some of these prices go up, which is why we were so bullish on October. And depending on when people stop buying in November would dictate how strong November is. But we think it really started to ebb and drop off pretty quickly as we headed into Thanksgiving, which again is going to result in much less activity for the for this period of time, which is why you look at payday loans, all of these pieces that are, again, pulling cash forward as people are finding themselves short on cash, given just where price increases have gone in the system. Store traffic, shoppers are visiting U.S. stores more than last year, but still below 2019 levels. So not surprising, we are seeing more people consume online versus in stores, but just shows just the amount of activity has started to pick up a bit as people feel more comfortable getting out into the market. And then when you look at adults overall are likely to anticipate spending a higher amount in November than they did in October. So here's where you look at what the expectations are. 57% are saying about the same as last month, a little more than last month, 19%, a lot more than last month, 10%. And then when you look at a lot and a little less, this is just going to be a matter of where things shake out and what the numbers are. So remember, November is always a strong month. So when we say that things are going to come down, we're talking about against historics of where November normally is and where is it going to be this time. And the reason why is, again, a lot of that it was pulled into October, which is going to keep November a bit muted. Then when we start going in a little bit deeper onto why, well, how much of your Black Friday shopping was done in stores versus online? This is where you can see for the largest part, I will do most of it, most or all of it in stores. You can see young people are still adamant about getting out there. I will do most of it or all of it online. As you go 25 and older, you can see more and more people are opting for that online, those online discounts, which are shown to be essentially just the same as in store. What percentage of your holiday shopping will be done at small businesses? I think people are trying to support some of those small businesses, which is good. I know Amex always has double the points if you shop small. So those are some positives to help support local entities. But then when you look at shopping, have shopping holidays jumped the shark? And I think this is an interesting one in terms of the Thanksgiving weekend e-commerce revenue in the United States. So this is what we keep looking at when we're talking about versus the previous years. So 2020, you had this big surge up. People were wanted to celebrate after a pretty terrible year. But now when you start looking at sales versus the 2020, you can see it's in billion US dollars. So it's not adjusted for inflation. So the numbers are actually below or equal to, and this is with inflation. So that's where you start looking at how things started to really cool off as we got into the end of November. And this is the estimated Thanksgiving weekend e-commerce revenue in the US. So speaking back to a lot of people, especially the people with the most disposable income, have been turning more towards online sales and e-commerce, and this is just showing that it actually came in below 2020. Now, some people did go back in stores, but by the time 2020 came around, November 2020 came around, you did have accelerating issues in terms of some COVID, but you can say the same right now. Again, people are a bit more comfortable, but even with when you back out inflation and turn these into real dollars, that's where you see just how weak some of this recent purchases were as we closed out November. Then when we start looking at personal savings, so personal savings as of October was down to 7.3%, which is the same it was in December 2019. Again, coming right back to that normal as all of that money has been pushed back into the market, which is why we see the reissuance of credit card debt, pay cash advances, and all of these I think very specifics for moving forward some of that cash into the system. Government transfer payments account for 19% of income, unchanged from the prior month. We expect to see this fairly, again, stable through the end of the year. Then when we look at personal consumption, October was a hotter month for PCE inflation. Month-over-month changes in core and headline PCE were stronger, bucking the trend of deceleration this year, which is, again, something that we had been talking about as we headed through into October, where we saw an acceleration into October, November, and then things starting to slow down into ending November, starting November strong, finishing November weaker, and then that continuing into December. So when we consider the personal consumption, then how that bleeds into, well, what's happening with general business activity? And that's when we start looking at the Dallas Fed, just again, trying to connect when we always talk about the different regional Feds and why we were factoring that in when we look at what is happening with consumption and spending. So the Dallas Fed, ticked down to 11.8 versus an estimate of 17. Production, new order shipments, wages, and hours were all up, but the outlook dipped. And it's still expanding, but again, the prices paid surged higher again. And this is where we continue to see some of that pressure, again, that offsetting when you look at inflation, deflation. So then when we look at the U.S. federal debt limits since 1993, we are going to have some fun conversations again in the news over the next 2 weeks as we get close to the debt limit once again, and that will bring back some fun movements. I don't see it being an issue at the moment. We'll probably see that can get kicked once again, but again, this will be something to watch play out. Now, inflation expectations. So the net percent of financial manager investors expecting higher inflation has come down. And again, this is expecting higher global CPI. So this is where we disagree. We still think that you're going to have a global amount of inflation, which is why we can get some more surprises because some people have think that we're past it or it's already been priced in. But when you think about inflation, you have to think about that excess cash per household, because when you think about global inflation overall, there's still some of that to come through. We're seeing PPI go up again. We're seeing CPI do it. When we'll cover a lot of that in segments 4 and 5. So that's where we disagree with the recent view, but there's still excess cash at the within the different quintiles, but which ones? And the top 20% of households, the excess cash per household is at 56,000, almost 57,000. But then it drops off quickly. And that's where we're already seeing more and more of this already get pushed back into the system, again, as we keep talking about, because this data is from June. And now, as we showed, that we saw this steady move down, and now a lot of this has been drained away as we saw an increase in not only inflation to the upside, but also sales in September, October. We've continued to see this whittle down, just to give you an idea of how much has been pulled out of the system in general. And then pricing power at an all-time high, and but pricing power is already there, so it's unlikely to increase further. And this is again summarizing what we've been saying. We don't expect it to increase anymore, but we don't expect it to decrease either. It's just really kind of sit in this level as things play out, again, leading more to that stagflation. And then the long tech continues to be the play, the soup du jour. We see it consistently with everyone that buys into the NASDAQ. And obviously, we had some negative come out from Apple talking about some slowing demand. But again, the tech continues to be a bright spot as we had another nice positive reversal again to the upside. And then inflation in comparison to rates. And this is one where, even though we're talking about global growth coming down, which in theory should lead to lower rates because growth is going to slow, you can see just how far off we are from what is normal given the CPI level and what the US 10-year is. So there's still some ground to make up, and that's something that I think is going to get priced back into the market as the Fed steps back and they start buying less and less treasuries, which is going to leave more, essentially let the market balance itself, driving up rates. So then when we look at job seeking, as we go and look at where jobs are, job seeking again continues to get better. And this is just showing that we continue and expect to see jobs increase again in November, once the official data comes out. Now, when we turn to home prices, so you see it creeped over, like turned over a little bit, but going back to the 1980s, we're still at all-time highs. So it's just, we're going to pause here. And that's some of the pieces where it's going to be a driving force behind the CPI. Home prices were up 19.5% year over year in September, down from 19.8% in the prior month. 20-city index was at 19.8% versus 19.3%. Phoenix, Tampa, and Miami reported highest year-over-year gains among 20 cities. Broadly, the pace of price increases has eased. So then when we start looking at the Case-Shiller overall on the rolling 1-month performance, yesterday's release of home prices data showed 20% year-over-year gain in September for S&P CoreLogic Case-Shiller U.S. National Home Price Index, making for the third straight month of 20%. Also marked a break in record postings with a slight deceleration in growth. So still elevated, but again, that growth is starting to pare back. But U.S. housing demand and supply, construction not started. So what do we know? We know that a lot of people are sitting there with, a lot of construction companies are sitting there with at least one or more shortages, which is just leaving them to not start the construction, waiting. And going back to 2000, you can see that the construction not started is at the worst ever. So housing completions has come down. Total home sales has also started to normalize, but that's because people have already bought and they're waiting for their homes to be built. And a lot of those delays will continue. But again, that delay and those shortages and keeping some of these construction companies buying, waiting for prices to normalize, some of these goods to be delivered, will keep prices elevated, supporting our view of the stagflation. As U.S. used vehicle values surged to a new all-time high. And you can see going back to 2007, it's relentless, and we don't see this slowing. We see it slowing, but again, you're just getting an idea of another positive contribution to the CPI calculation. The consumer spending rotation. Consumer spending was strong, up 1.3% in October. Real spend up 0.7%. Income was up by 0.5% because of compensation, as unemployment was down. PCE prices were up 0.6% and the highest since 2008. Inflation at 5%, up 0.6%, and highest since 1990. Core prices at up to 0.4%, the 5-month high. Core inflation at 4.1% and up 0.4%, highest since 1990. So you're getting an idea that you're still getting these pressure points, but consumer spending is still coming through. Durable good new orders continue to move up, again, feeding into new orders coming through, people trying to close that gap as some of the spending, again, kind of finishes itself out, as we do expect some slowdown in November and December. And then when we start looking at new home price sales, you can see that they're getting more expensive, which is not surprising. And you can see that about 50% and more are $400,000 or more expensive, or a cost $400,000 or more. With the essentially what used to be called an entry-level house doesn't exist anymore. They either get bought, knocked down, and built back up, and they're more expensive because there's more square footage, or people will buy it and add a second floor or add some sort of improvement that then takes it out of that pricing range. Single family starts in current versus previous cycle. Here you can see that 2020, we're starting to see them slow down again, just because there's a significant amount of construction not started, as we showed earlier, which even though we came out of this very quickly, we're actually coming back down. And then new privately owned housing units authorized but not started, just showing the same thing, just back to that new all-time high going back to 1984. And then new privately owned homes under construction. So both of them are going up, and you're going to have one feeding into the other, which should help a bit on the supply side. Change in bank standards for commercial real estate loans, they've dropped back down as they're trying to move money, as again, banks are sitting on a plethora of cash and they're trying to find ways to move it back into the system. Now, when we look at U.S. pending home sales for October, pending home sales were at plus 7.5% versus the estimate of 0.8%. Midwest led with 11.8% gain while West lagged. And here you can see, again, just looking at it overall, how things continue to get better. And then personal consumption, when you look at just in general, continues to trend higher. Real personal consumption, balance it out for inflation, continues to maintain where we were in October, which again, we believe rolls over again. And then the core PC inflation, the Fed's preferred measure, climbed above 4% for the first time in a decade. And this is something that we think continues to go up, but again, starts to roll over a bit, and just the pace of it slows down over this time period. And then when we look at who is buying homes, so investor market share hits a record, which just means that investors are buying homes. So share of purchased U.S. Homes bought by investors reached a new record at 18.2%. Investors buy up a record 90,000 homes in the third quarter. And again, just seeing the amount of activity that is coming in from the investment community. Investors hone in on single family homes. So typically they used to buy co-ops, townhomes, things that would have different types of revenue streams and multiple tenants. And now you're seeing a big increase into single family residential, and low priced homes make up smaller share of investor purchases because obviously there's not that many available. So you're starting to see that break down as well. So now that we've gone through and kind of rounded that out, we want to look at Europe and how costs and inflation are really accelerating, and what does that mean as we head into 2022.